Start with the basics. What exactly is a mutual fund? Imagine a large pool of money collected from many investors just like you. This pool is then managed by a professional fund manager who invested in a variety of assets such as stocks, bonds, or other securities. The main idea is to make investing easier and more accessible, even if you don't have a lot of money or deep financial knowledge. By pooling resources, investors can access a diversified portfolio and benefit from professional management. This is the foundation of mutual funds, making them a popular choice for both beginners and experienced investors. Now let's see how mutual funds actually work. When you invest in a mutual fund, you're buying units or shares of that fund. The fund manager then uses the combined money from all investors to buy a mix of assets. The value of your investment goes up or down based on how well these assets perform. You don't have to pick individual stocks or bonds yourself. The fund manager does all the research and decision making for you. This process makes investing much simpler and less stressful for most people, especially those new to the world of finance. Mutual funds come in many different types, each designed to meet specific investment goals. Some funds focus on stocks aiming for higher growth but with more risk. Others invest in bonds, which are generally safer but offer lower returns. There are also balanced funds that mix both stocks and bonds for a more moderate approach. By choosing the right type of mutual fund, you can align your investment with your personal risk tolerance and financial objective. Understanding these types is key to making informed decisions. Equity mutual funds primarily invest in stocks. These funds are ideal for investors looking for growth over the long term. While they offer the potential for higher returns, they also come with higher risks due to market fluctuations. Equity funds can focus on different sectors, company sizes, or even specific regions. If you're comfortable with some ups and downs in your investment value and have a longer time horizon, equity mutual funds might be a good fit for you. Mutual funds invest mainly in fixed income securities like bonds, government securities, and other debt instruments. These funds are generally less risky compared to equity funds, making them suitable for conservative investors or those seeking stable returns. Debt funds are often used for short to medium-term goals, and they can provide regular income through interest payments. However, they may offer lower returns compared to equity funds, especially over the long term. Balanced mutual funds, also known as hybrid funds, invest in a mix of stocks and bonds. This approach aims to balance risk and reward, offering moderate growth with some level of safety. These funds are great for investors who want exposure to both equity and debt but prefer not to go all in on either. Balanced funds can help smooth out the ups and downs of the market, making them a popular choice for many investors. Index funds are a type of mutual fund that aims to replicate the performance of a specific market index, like the S&P 500. Instead of trying to beat the market, these funds simply track it. This approach usually results in lower fees and less active management. Index funds are popular among investors who want broad market exposure and are comfortable with average market returns. They're often recommended for beginners due to their simplicity and cost-effectiveness. Actively managed mutual funds have fund managers who make regular decisions about which assets to buy or sell. Their goal is to outperform the market or a specific benchmark. While these funds can potentially deliver higher returns, they also come with higher fees due to the active management involved. Success depends largely on the skill of the fund manager, and there's no guarantee of beating the market. It's important to weigh the potential rewards against the costs. Passive mutual funds, like index funds, don't try to outperform the market. Instead, they aim to match the performance of a specific index. This means less buying and selling, which keeps costs low. Passive funds are ideal for investors who prefer a hands-off approach and want to minimize fees. Over the long term, many passive funds have performed as well as or even better than many actively managed funds, especially after accounting for fees. Open-ended mutual funds are the most common type. They allow investors to buy or sell units at any time, based on the fund's current net asset value (NAV). This flexibility makes them very liquid, meaning you can access your money relatively easily. Open-ended funds continuously issue new units as investors buy in and redeem units when investors sell. This structure is ideal for those who want the freedom to invest or withdraw whenever they choose. Closed-ended mutual funds issue a fixed number of units during a specific period, usually through an initial public offering (IPO). After that, these units are traded on the stock exchange just like stocks. The price of closed-ended fund units can fluctuate based on demand and supply, sometimes trading at a premium or discount to the fund's NAV. These funds are less liquid than open-ended funds, but they can offer unique investment opportunities. Net asset value, or NAV, is a key concept in mutual funds. It represents the per unit value of the fund's assets minus its liabilities. NAV is calculated at the end of each trading day and determines the price at which you can buy or sell units in an open-ended fund. Understanding NAV helps you track the performance of your investment and make informed decisions about when to invest or redeem your units. Fund managers play a crucial role in mutual funds. They are responsible for making investment decisions, selecting assets, and managing the fund's portfolio. A skilled fund manager can help maximize returns and manage risks effectively. When choosing a mutual fund, it's important to consider the track record and experience of the fund manager, as their expertise can have a significant impact on your investment's performance. One of the biggest advantages of mutual funds is diversification. By pooling money from many investors, mutual funds can invest in a wide range of assets. This reduces the risk of losing money if one investment performs poorly because other investments in the portfolio may do well. Diversification helps smooth out returns and provides a more stable investment experience, which is especially valuable for new investors. Liquidity refers to how easily you can access your money. Most mutual funds, especially open-ended ones, are highly liquid. This means you can buy or sell your units on any business day at the current NAV. Liquidity is important because it gives you flexibility to respond to changes in your financial situation or market conditions. However, some funds may have exit loads or restrictions, so it's wise to check the terms before investing. Mutual funds are managed by experienced professionals who have access to research, data, and market insights. This professional management can be a huge advantage, especially for investors who don't have the time or expertise to analyze individual investments. Fund managers make decisions on your behalf, aiming to maximize returns while managing risk. This allows you to benefit from their knowledge and experience without having to do all the work yourself. Mutual funds are accessible to almost everyone, thanks to their affordability. You don't need a large sum of money to get started. Many funds allow you to invest with small amounts, sometimes as little as $50 or $100. This makes mutual funds a great entry point for new investors or those with limited capital. Over time, even small investments can grow significantly through the power of compounding. Transparency is a key feature of mutual funds. Fund houses are required to disclose information about their holdings, performance, fees, and other important details on a regular basis. This allows investors to make informed decisions and track how their money is being managed. Regular updates and reports help build trust and ensure that investors are always in the loop about their investments. Systematic Investment Plan, or SIP, allows you to invest a fixed amount in a mutual fund at regular intervals, such as monthly or quarterly. SIPs make investing disciplined and convenient, helping you build wealth gradually over time. By investing regularly, you can benefit from repeat cost averaging, which means you buy more units when prices are low and fewer when prices are high. SIPs are a popular way to invest for long-term goals. Lump sum investment means putting a large amount of money into a mutual fund at one time, instead of spreading it out over regular intervals. This approach can be beneficial if you have a windfall or want to invest a bonus. However, it also exposes you to market timing risk, as your entire investment is subject to the market's ups and downs from the start. It's important to consider your risk tolerance before choosing this method. Expense ratio is the annual fee charged by mutual funds to cover management and administrative costs. It's expressed as a percentage of your investment. Lower expense ratios mean more of your money stays invested and working for you. While actively managed funds usually have higher expense ratios, passive funds like index funds tend to be cheaper. Always check the expense ratio before investing, as high fees can eat into your returns over time. Mutual funds charge entry or exit loads, fees for buying into or selling out of the fund. Entry loads are less common today, but exit loads may apply if you redeem your units within a certain period. These charges are meant to discourage short-term trading and help manage fund stability. Always review the fee structure before investing to avoid surprises when you decide to withdraw your money. Taxation is an important aspect of mutual fund investing. The tax you pay depends on the type of fund and how long you hold your investment. Equity funds and debt funds are taxed differently, and there are separate rules for short-term and long-term capital gains. Understanding the tax implications can help you plan your investments more efficiently and avoid unexpected tax bills. Any investment, mutual funds come with risks. Market risk, credit risk, and interest rate risk are some of the main types. The value of your investment can go up or down depending on market conditions and the performance of the underlying assets. While diversification helps reduce risk, it doesn't eliminate it entirely. It's important to assess your risk tolerance and choose funds that match your financial goals and comfort level. Returns from mutual funds can come in two forms: capital gains and dividends. Capital gains occur when the value of your units increases, while dividends are periodic payouts from the fund's earnings. The total return you receive depends on the fund's performance and the market environment. Remember, past performance is not a guarantee of future results, so it's important to set realistic expectations. In investing in mutual funds, you can usually choose between growth and dividend options. In the growth option, your returns are reinvested, helping your investment grow over time. In the dividend option, you receive regular payouts from the fund's earnings. The right choice depends on your financial needs. If you want regular income, go for dividends. If you want to build wealth, choose growth. Investing in mutual funds is straightforward. You can invest directly through the fund house's website, via a financial advisor, or through online platforms. The process usually involves filling out a form, completing KYC, know your customer requirements, and choosing your preferred fund and investment amount. Many platforms also offer tools to help you compare funds and track your investments easily. Selecting the right mutual fund depends on your financial goals, risk tolerance, and investment horizon. Start by identifying your objectives. Are you saving for retirement, a house, or your child's education? Next, assess your comfort with risk and how long you can stay invested. Use these factors to compare different funds and find one that matches your needs. Don't forget to review the fund's past performance, fees, and manager's track record. For investing, it's important to read the fund's offer document and fact sheet. These documents provide details about the fund's objectives, investment strategy, risks, fees, and past performance. Understanding this information helps you make informed decisions and avoid surprises later. Always take the time to review these documents, even if you're investing through an advisor. Once you've invested, it's important to track your mutual fund's performance regularly. Most fund houses and online platforms provide easy access to your portfolio and performance reports. Monitoring your investment helps you stay informed and make adjustments if needed. However, avoid checking too frequently, as short-term market movements can be misleading. Focus on your long-term goals and review your portfolio periodically. Sometimes you may want to switch from one mutual fund to another. This could be due to changes in your financial goals, poor fund performance, or a shift in market conditions. Most fund houses allow you to switch between their funds easily, but it's important to consider any exit loads, tax implications, and whether the new fund aligns with your objectives. Make sure to review your options carefully before making a switch. If you need to access your money, you can redeem your mutual fund units. The process is usually simple. Submit a redemption request online or through your advisor, and the money is credited to your bank account within a few days. Be aware of any exit loads or tax implications before withdrawing. Planning your withdrawals can help you avoid unnecessary costs and make the most of your investment. Reinvesting your returns can help your investment grow faster through the power of compounding. Many mutual funds offer the option to automatically reinvest dividends or capital gains. This means your earnings generate more earnings over time, accelerating your wealth building journey. Reinvestment is especially effective for long-term investors who don't need immediate income from their investments. There are several myths about mutual funds that can discourage people from investing. Some believe mutual funds are only for experts or that they're too risky. Others think you need a lot of money to start. In reality, mutual funds are designed for all types of investors, offer varying levels of risk, and can be started with small amounts. Understanding the facts can help you make better investment decisions. Mutual funds offer several benefits: diversification, professional management, liquidity, affordability, and transparency. They make it easy for anyone to invest in a wide range of assets without needing deep financial knowledge. Whether you're saving for retirement, a major purchase, or just want to grow your wealth, mutual funds can be a valuable tool in your financial plan. While mutual funds have many advantages, there are also drawbacks to consider. Fees and expenses can reduce your returns, and there's always some level of risk involved. You also have less control over individual investment choices since the fund manager makes those decisions. It's important to weigh these factors and choose funds that fit your needs and comfort level. Pairing mutual funds involves looking at several factors: past performance, fees, risk level, fund manager's track record, and how well the fund matches your goals. Use online tools and fund fact sheets to compare options side by side. Don't just focus on returns, consider the overall fit with your investment plan. A well-chosen fund can help you achieve your financial objectives more effectively. Mutual funds can play a key role in your overall financial plan. They offer flexibility to invest for different goals, such as retirement, education, or buying a home. By including mutual funds in your portfolio, you can diversify your investments and manage risk more effectively. Work with a financial advisor if needed to create a plan that incorporates mutual funds and aligns with your long-term objectives. Investing in mutual funds is different from buying individual stocks. With stocks, you're responsible for researching and picking companies, which can be time-consuming and risky. Mutual funds, on the other hand, offer instant diversification and professional management. They're ideal for investors who want exposure to the stock market without the hassle of managing individual investments. Exchange-traded funds, or ETFs, are similar to mutual funds but trade like stocks on an exchange. ETFs usually have lower fees and can be bought or sold throughout the trading day. Mutual funds, especially open-ended ones, are priced once a day at NAV. Both have their pros and cons, so it's important to understand the differences and choose the one that best fits your investment style. Mutual funds are regulated by government authorities to protect investors. Regulations ensure transparency, fair practices, and regular disclosures. While regulation can't eliminate all risks, it does provide a layer of safety and accountability. Always invest in funds registered with the appropriate regulatory body to ensure your money is protected. Global mutual funds invest in assets outside your home country, offering exposure to international markets. These funds can help diversify your portfolio further and tap into growth opportunities worldwide. However, they also come with additional risks such as currency fluctuations and geopolitical events. Consider global funds if you want to broaden your investment horizon. Technology has made investing in mutual funds easier than ever. Online platforms and mobile apps allow you to research, compare, and invest in funds with just a few clicks. You can track your portfolio, receive updates, and even automate your investments. Embracing technology can help you stay informed and make smarter investment decisions. If you're new to mutual funds, start by educating yourself about the basics. Set clear financial goals, assess your risk tolerance, and begin with small investments. Use SIPs to build your portfolio gradually and avoid trying to time the market. Regularly review your investments and don't hesitate to seek advice from financial professionals if needed. Remember, patience and discipline are key to successful investing. Sum up, mutual funds are a versatile and accessible investment option for people at all stages of their financial journey. They offer diversification, professional management, and flexibility to suit different goals and risk profiles. By understanding how mutual funds work and following best practices, you can make informed decisions and build a strong foundation for your financial future. Take the next step by exploring funds that match your needs and start your investment journey today.